So many things happened on the financial markets, but one of the most important was the FOMC press conference. Now, Jay Powell, chair of the Federal Reserve, was very transparent about a few things, but he also dodged many important questions. Mr. Powell definitely put the gloves on because he said that there is a lot of room to raise interest rates without threatening the labor market. It's quite a dangerous statement because we can clearly see from the data that there is a lot of job openings, but the problem with this is that these are not new jobs. These jobs were already there before the pandemic, and we can clearly see it from the labor market participation data that people are unwilling to take up these jobs. With the interest rate increase, what they're going to achieve is they're going to force the lower class people to take up these jobs until the job market dries up. Going back to the press conference, okay, we understand that you need to tackle inflation, therefore you need to be hawkish, but the problem is that Mr. Powell refused to answer some important questions. For example, how many basis points are they going to raise interest rate? Is it the standard 25 or 50 basis point? Also, he refused to comment about how the Fed is going to reduce its $9 trillion balance sheet. Are they going to let the outstanding debt simply mature? Are they going to sell off some assets? Or are they planning to change the composite of the balance sheet? No answers. But the big question is, can they really tackle inflation? So if you look at the hard data, inflation is at 7%, the interest rate is at 0.25%, which leaves us with a real yield of minus 6.7%. So it doesn't matter if the Fed is going to increase interest rate this year 3 times 50 basis points, they are already still behind. And what is the guarantee that they're actually going to raise interest rate 3 times this year in this economic climate? Again, look at the hard data and decide yourself. On the chart, you can see that the past 10 years of rate hike projections and the actual rate hike. Now, there is a really big difference between what they planned and what they achieved to do. Now, as the saying goes, a barking dog never bites, but in this case, a screaming hawk never backs. And finally, let's look at the technical analysis you've been all waiting for. Stay tuned, it's coming. Starting off with the bigger picture, we're looking at the daily time frame to observe the characteristics and the dynamic of the gold spot market. You can see how the gyration and velocity started to flatten out since the break of the bearish channel back in May 2021, giving us a clear ceiling of resistance levels at 1830, 1855 and 1900s, and bottoms of support level at 1780, 1750 and of course the famous 1680. So it's extremely difficult to pinpoint where is the exact bottom level. So for now we have to work with what we have and look for the confirmations I'm going to explain in a minute. I forgot to mention that the Fed is going to have some problems this year. Remember that they communicated that the rate hikes will be data dependent. Of course, they didn't tell us what data they're looking at, but think logically. They're already expecting an economic slowdown in 2022. The labor market is tight already, and inflation is probably going to peak out in the middle of 2022. It doesn't mean that the prices are going to come down, but the rate of change is going to slow down. And the Fed is just starting its contractionary monetary policy in a possibly contracting economic environment.
What? Hold up, wait a minute. Wow. Oh.
That means only one thing, boys. Gold is going to skyrocket to 2000s this year. Before I show you the forecast which will help you to buy your first Lamborghini, if you want to see my daily positions, join our morning briefings with top funded traders, or just get daily analysis of major currency pairs, US 30 and of course gold, then take advantage of the 50% discount that ends today. Visit alphafx.eu and take one of the last memberships left. Looking at the 4-hour time frame, you can see that last week gold wiping out all the gains it has built up since the beginning of January. If I go back to the 8-hour time frame, you can see this nice closing in wedge, and if I go back to the 4-hour time frame, you can see how nicely the bottom trend line, the daily support level and the Fibonacci 161 level catched gold and gave a foundation for a very good support level. You can see that we already started breaking the trend lines on a lower time frame, and what's coming next is the break of market structure. So what I'm expecting is gold to come back all the way to around 1800s, bounce back down and start to create forming a bullish market structure, which could be easily an upside down head and shoulders, or it could be high highs and high lows, giving us nice bullish formations, and it definitely going to retest 1830 the sooner or later. So if you haven't entered into this position, go down to a lower time frame, for example the M30, M15 or whatever time frame you like. Most likely gold is going to break to the upside with an impulse bullish move, wiping out the previous lower highs and lower lows, and then it's most likely going to come back and retrace
to the beginning of the impulse move. And then you have to use your Fibonacci or whatever tools you use, and you have to find the entry point, which is most likely going to be a higher low. But do not rule out the possibility of, a double bottom or equal low, because the last support level is at 1780 level. You have to place your stop loss around 1777, so it's a $3 to $4 stop loss. If gold comes down all the way to 1787, which was my entry level, you see that I was in a drawdown, but finally out of the woods now. It's expected that price is going to come back all the way down to 1830. It's going to suck it up like a magnet, because 1830 is historically a really important level. So this is what I'm expecting for next week. But let me show you another scenario, because, sometimes things don't go as planned, but you have to be ready to every possible scenario. There is no excuse. So in case if this setup is fails, then you can't buy your Lamborghini, and price is going to wipe out our stop loss, come down below 1777 or 1780. The next thing you have to watch, every important support level was wiped out with an impulse move to the downside. So if this happens again, all you have to do is wait for the retracement, which could be the previous support levels at 1781 or 1764. If these support levels become resistance, and if they respect the resistance levels, then my friends, we are going to see 1750 and 1680 again. Important thing is, if you want to get notifications about when I go live on YouTube or when I do live trading, make sure you join my Telegram channel, enable notifications, and be ready when the time comes. This is the Alpha FX.